Hey everyone, welcome back. Today in part two, we're breaking it all down. No fluff, no complicated jargon, just straight talk so anyone can understand how the market really behaves. In part one, we went over the fundamentals, what stocks are, ETFs, and IPOs. If you missed it, check the link in the cards or description. It's worth a watch. Let's start. Term one, bull market. A bull market is simply when stock prices are trending upward over a decent period of time. The economy feels strong, companies are growing, people are optimistic, and investors are confident. Think about how Apple, Microsoft, and Nvidia have climbed steadily for years during good times. That's classic bull market behavior. The fun part, during a bull market, almost everyone feels like an investing genius. Your portfolio goes up, your coworkers goes up, even your friend who barely checks their app is smiling at their gains. But here's the reality check. Bull markets don't last forever. The people who get too comfortable and forget that, they're usually the ones who get hit hardest when the tide turns. Term two, bear market. Now, the opposite, bear market. This is when prices are falling sharply and fear starts spreading. People sell in panic, and the downward spiral can feel scary. Remember the big drop in early 2020 during COVID? The market fell over 30% in just a few weeks. Pure bear market chaos. Most beginners make the same mistake here. They see all the red numbers, panic, and sell at the bottom, locking in their losses forever. Smart, experienced investors look at it differently. They treat a bear market like a huge sale at their favorite store. Stocks go on discount. The calm ones who keep buying quality companies during the fear, they're usually the ones who build serious wealth when the market eventually recovers. Fortunes are often made in bear markets. Remember that. Term three, market capitalization. Next, market cap, short for market capitalization. It's a simple way to measure how big a company really is in the eyes of the market. The formula is easy. Current stock price times total number of shares outstanding. Companies generally fall into three buckets: large cap, giants like Apple, Amazon, Microsoft, or Google. These are usually more stable, established businesses with lower risk. Mid cap, growing companies in that sweet spot, more potential upside but a bit more risk than the big ones. Small cap, small companies with massive growth potential, but also bigger chance of big drops. High risk, high reward. Think of market cap as your quick risk radar. Want steady, reliable growth? Stick mostly with large caps. Feeling adventurous and want bigger possible returns? Small caps can deliver. Just be ready for the roller coaster. Term four, market indexes. When you hear on the news that the market was up 300 points today, they're usually not talking about every single stock. They're referring to market indexes, basically the market's overall report card. Here are the big ones you should know. The S&P 500 tracks the 500 largest U.S. companies. This is the main benchmark most people watch. If you're only going to follow one thing, make it this. The Dow Jones focuses on 30 big, well-known blue-chip companies. It's old school, but still respected. The Nasdaq, tech-heavy. Think Apple, Tesla, Nvidia, and other growth stocks. When tech is hot, the Nasdaq usually shines. These indexes show the general mood of the market. When they're rising, things feel good overall. When they drop hard, it's time to pay attention. Number five, volatility. This one confuses a lot of new investors. Volatility simply measures how much and how quickly prices are swinging. Big ups and downs equals high volatility. Smooth, steady moves equal low volatility. A perfect example is Tesla stock. It can jump 10% one day and drop 8% the next. That's high volatility in action. Here's the key. Volatility isn't always bad. For traders with experience and a clear plan, those big swings create real opportunities to buy low and sell high. But if you're just starting out and don't have a clear strategy yet, high volatility can shake you out and cause big mistakes. So respect it. Don't fear it, but don't ignore it either. Last one for today. Liquidity. This answers a simple question. How quickly and easily can you turn your shares into actual cash without losing a lot of money? Highly liquid stocks like Apple have millions of shares trading every day. You can sell even a big position in seconds without moving the price much. On the other hand, some tiny or obscure stocks have very few buyers and sellers. You might want to sell, but if no one's buying, you're stuck holding the bag. Liquidity is what makes a stock feel more like real money in your pocket. As a beginner, always check it before jumping into anything unfamiliar. So there you have it, the 6 key concepts every new investor should understand. Bull markets, bear markets, market cap, indexes, volatility, and liquidity. These aren't just fancy words, they're tools that help you make calmer, smarter decisions with your hard-earned money. In Part 3, we're going deeper into the numbers that serious investors use, things like PE ratio, EPS, and financial ratios that actually help you spot good stocks. It's going to be a game changer. If this video cleared things up for you, do me a quick favor. Hit that like button, subscribe if you're not already, and drop Part 3 in the comments so I know you're coming along for the ride. Thanks for watching. I'll see you in the next one. Take care.